Hello and welcome. In this lecture video, I'm going to be talking about bond amortization, the bond amortization schedule for discount and for premium, and also the journal entry to issue bonds at a premium. Okay, so in the last lecture video, we talked about how to calculate the bond interest discount that's going to be amortized, but we took the total amount of the discount divided by the total amount of payments for the bond that I'm going to make. That gave us 887. This, recall, you can think of this as additional interest, because remember, you get 96,454. This is how much, if we look at the other page, 96,454 is how much cash we got, but yet we still have to pay back $100,000 at the end of 2 years, which is the maturity date is 2 years from now. So we have this 3,546, which is the difference between how much cash you got, and then how much you have to pay back. This is the discount, and we can think of this as additional interest. Now the problem is that if we didn't do this journal entry where we amortized this discount and stretched it out over the 2 accounting periods, we would essentially be recognizing this 3,546 all in the second year when we paid it back. The problem with that is it violates the matching principle. Remember the matching principle, we want to match revenues and expenses in the same accounting period. We are using that cash of 96,454 that we get from issuing these bonds to generate revenue. And so we should, per the matching principle, then take this discount, which is, think of it conceptually as additional interest, and spread it out over the 2 accounting periods, which are the 2 years. Recognize some in the first year and some in the second year, because we're using that cash to generate revenue in the first year and the second year. So we want to match the revenues and expenses. So the easiest way to do that is to take the total amount of the discount divided by the total amount of payments, 887. And what we did is we calculated the interest to our bondholders, par value times contract rate, 4,000. We added that 887, which is the amortized discount, to give us our total debit to bond interest expense of 4,887. Credit to cash, this is always how much we pay our bondholders, is always equal to par value times contract rate. That's how much we pay our bondholders. And then we credit our discount on bonds payable. The normal balance for our discount is a debit, and that's what we did when we issued the bonds. We debited cash, we debited the discount, we credited bonds payable. So when I credit this discount, I'm reducing the total balance in the discount. And we can see that here in our table. So we look at our first journal entry. This is how much cash we pay. Here's our debit to bond interest expense. This is our discount amortization right over here. So that means, remember, when we issued the bonds, we had our debit to our discount of 3,546. We credited it for 887. The outstanding discount is now 2,659. Then look at the carrying value. Remember, the carrying value is equal to the par value minus the unamortized discount. This is our unamortized discount. It went down by 887. Par value is still 100,000. So 100,000 minus a smaller number means the carrying value goes up. Look at the next journal entry. It's always the same amount, 4,887, because we divided it by 4. So it's always the same amount. That's why it's called straight line. 887 here, unamortized discount, 1,772. It's 887 lower. Our carrying value goes up. Same thing with the last accounting period. It's a little bit different due to rounding. Our carrying value right up to here to 100,000. So when these bonds mature, the carrying value will be equal to the par value. When these bonds mature, the carrying value will be equal to the par value. And at that point, we would pay back the par value, we would debit bonds payable, and then we would credit cash to pay back the par value, which is going to be equal to the carrying value. Okay? So let's go on to the next page and talk about issuing bonds at a premium. Remember, bonds issued at a premium, that basically means that our contract rate is higher than our market rate. So we, the bond issuers, are paying more than companies similar to us for the same type of bond. Our rate of return, our rate is higher than what they're paying. So that means people want to buy our bonds. What happens to the price of something when everybody wants to buy it? It goes up. So we have a bond premium. Okay? Let's take a look at our example. Suppose our company, Adidas, or as they say in the UK, Adidas, issues bonds with a $100,000 par value. This is the par value. This is my contract rate. 2-year life, so it matures in 2 years. Assume that the market rate is 10%. So you can see our contract rate is higher than our market rate. It's issued at a premium. And then this is how much cash we get. This is how much cash we get. Okay? So when we look over here on our next page, to record the journal entry to issue these bonds, we will get cash equal to that 103,546. So we get debit cash for $103,546. We will credit our bonds payable for the par value of $100,000. And then, rather than debiting the discount that we did for our discount bond, now we're talking about a premium bond, we credit the premium on bonds payable for $3,546. And that becomes our journal entry, okay, to issue the bonds. Now you might be saying, well, this is a great deal. I get $103,546. That's how much I get up front, and I only have to pay back $100,000? Yeah, fantastic deal. What's the problem? Look at your interest payments. It's $6,000. And the other problem that we did with the discount, it was only $4,000. So you're going to be paying more in interest to your semi-annual interest payments to your bondholders. And that's why you get more cash up front. Okay? With our discount, with our premium, it's not good or bad. It's just a function of the time delay between getting authorization to issue the bonds and then issuing the bonds, and the fact that the market rate can change during that time period. That's all it is. It's not good. It's not bad. It's just a function of the market rate changing. Okay? So now what we want to do is we want to talk about how to amortize that bond premium, similar to what we did with our amortizing our bond discount. And we also want to talk about how to record bond interest expense with a premium. We talked about how to record bond interest expense with the discount. Now we're going to talk about how to record bond interest expense with a premium. Okay, so we do the same thing. Look at the bond premium. The total amount is $3,546. And by the way, let me come back over here before I did get ahead of myself. That premium is called an adjunct liability account, also called an accretion account. Okay, and it has a normal balance of a credit. So what we're going to do, similar to what we did with that discount, is we're going to take the total amount of the premium divided by the total amount of payments we have to pay our bondholders. So how did I get 4? It's a 2-year bond, semi-annual, 4 total payments. We get the same amount, $887. Now, the total amount of bond interest expense that we have to pay is going to be equal to how much we have to pay our bondholders, which is always par value times contract rate. In this case, the contract rate is 12%, but it's semi-annuals. So it's 100,000 times 0.06, or 100,000 times 0.12 times 0.5, same answer. Total bond interest expense is going to be how much we pay our bondholders minus our amortized bond premium. Okay? That's how we figure out our debit to bond interest expense. So in this case, we take our $6,000, which is how much we're going to pay our bondholders, minus the $887, which is the amortized premium, gives us our debit to bond interest expense right there. Okay, so we'll do our journal entry, debit to bond interest expense for $5,113. And again, I'm going to write out how I got that $6,000. Remember, it's our 100,000 times our contract rate, which, remember, our contract rate was 12%, but that's 12% per year, or 6% every 6 months. Gives us $6,000 right there. So I'll credit cash my $6,000. That's how much I'll pay my bondholders. You know from Accounting 101 that this is not a valid journal entry. I'm missing a debit right over here. So I'm going to then debit my premium on bonds payable for the difference, which is $887, which is the amortization. Now, if we look on this page, look over here, see the premium has a normal balance of a credit. So if I debit it, what's going on? It's going down. Okay? So the total amount of the unamortized bond premium will decrease by $887 after I do this journal entry. And so if we think about this in terms of the key takeaway message, a bond premium decreases bond interest expense. A bond discount, remember we took how much we have to pay our bondholders plus the amortized discount. So a bond discount increases bond interest expense. Let's talk about the carrying value of the bond for a premium bond. Okay, so I'm going to go over to the next page and let's take a look at this. So remember when we issued the bond, we had that carrying value of $103,546. And let's talk about here how to calculate the carrying value for a premium bond. Remember what we said with a discount bond, it was par minus the unamortized discount. In the case of a premium bond, it's par value plus unamortized premium. Okay, so when we issued it, remember we debited cash and we credited bonds payable for the par, the 100,000, and then we credited the premium on bonds payable for the 3,546. And when we look at this journal entry right over here, we debited the premium, which means this unamortized premium number goes down by $887. So look at right here, $2,659. It's $887 less. My par value stays constant, 100,000, plus a smaller number, the carrying value goes down. So what's happening over here is you can see the carrying value of the bond is decreasing until maturity, at which point the carrying value of the bond equals the par value of the bond, and then I would pay back the par value by debiting bonds payable and crediting cash. Okay, so look at what's happening again. The unamortized premium is decreasing by $887, which is how much I amortize it by. Okay, and then look at my bond interest expense. It's lower than the amount that I actually have to pay my bondholders. Okay, and again, the way we calculated this is by taking that $6,000, which is how much we have to pay our bondholders, par value times contract rate, minus our amortized premium, which is equal to our total premium divided by the total number of payments, 4 in this case, 887, 6,000 minus 887 gives us to our debit to bond interest expense. Okay. All right. Well, thank you so much. In the next lecture video, we'll go over these quick check problems. Thanks.